Welcome to the Jill on Money Coronavirus Market Update. It is Tuesday, August 18th, and we are here. It is the summer, and we are answering your questions. Obviously, there have been incredible shifts in how the virus is spreading, and it really has impacted almost everyone's finances in some way. There was a recent study that found that about half of Americans said that they have been negatively impacted by coronavirus. That could be financially. I'm sure that just generally speaking, people are freaked out. And we allow you to be freaked out. Everyone of us is getting a little freaked out, and that's okay, especially as this persists. If you are feeling a little bit uptight about things, why don't you send us an email? We can help you out. Our email address is askjill@jillonmoney.com. askjill@jillonmoney.com. Michelle writes, the subject is investing during the pandemic. Hello there to you. I hope you and yours are safe and well. I am a huge fan. Is now a good time to invest for retirement, or should we hold on to our cash? Okay, Michelle, it really depends on your situation. If you're telling me that you've got an emergency reserve fund and it's all built up, then sure, and you're a long-term investor, go ahead and invest. If, however, you don't have 6 to 12 months of expenses that's sitting in a boring account, a money market, a checking savings, a short-term CD, then no, don't invest. But if you're a long-term investor and you got your house in order, absolutely. Mita writes, I love your show. I've got a question about a Roth 401k. I contribute 5% to a Roth in my 401k at Fidelity. I heard you mention on the show that they should be in separate accounts in order not to be taxed twice at a later date. I just want to confirm you meant Roth money in a traditional 401k and not a Roth account. Yeah, don't worry about this. What I'm talking about is when people make after-tax contributions into a retirement account and then they convert it to a Roth, then that should be separate. But if you have a 401k at Fidelity and it's a Roth, then you don't have to worry about it. That's fine. We want to make sure that monies are separated that have been taxed already, and those that haven't been taxed are also separate. So if it's a pre-tax, you want it separate from anything that's a Roth or post-tax. I hope that helps. Here's a question from Joe, also about a Roth. You mentioned it's a good idea to convert to a Roth in a down market. Why is it important to pay the tax on the conversion with money outside the traditional IRA? Because then you are actually pulling money out of the IRA and using pre-tax dollars that you then have to pay tax on again. So it just doesn't make as much sense. Also, if I take a portion of my $800,000 traditional IRA now and convert to a Roth while staying in the same tax bracket, versus 6 months ago, I'd pay the same amount in tax. Why is it better to convert in a down market if I'm only converting a portion? Because the portion that you're converting is down in value. If your markets are moving around, it doesn't make sense. But just imagine this. If your 800,000 goes down to 600,000 and you pull money out, you're pulling money out at a lower level. And that lower level means you're paying a lower amount of tax. So that's how it's just kind of simple. Don't overthink this, okay? Eric writes, I appreciate your updates and the answers. I was a huge fan of yours before you started the daily emails and answers. This has just confirmed how great you are. I apologize if you've already answered a question like this. Here's the situation. Back in October, I accepted a job and I got a nice pay increase, about 25%. We used the extra money to pay down student loan debt, started to save for a house, etc. Unfortunately, I couldn't contribute to my new employer's 401k for a year. To keep up with retirement savings, I started contributing my after-tax money to a Vanguard brokerage account invested in the S&P 500 index. I set up automatic monthly investments to be the equivalent of maxing out my 401k. What a very clever, Eric. Well done. My wife and I have been good about paying down debt, 50 grand in student loan debt between the two of us, and keeping a healthy emergency fund of 6 months of expenses. That said, we're not where I think we should be with our retirement savings. 250 grand saved for retirement. We're both about 40. Then COVID hit. My employer just announced that all staff would be taking a 30% pay cut to prevent layoffs. Depending on how things go over the next 2 months, there could be layoffs. I'm grateful to have a job. Glad none of my coworkers have lost theirs. Here's my question. Should I keep making my quote retirement contributions to the Vanguard account? Should I reduce the contributions by 30%, just not make them at all? With the pandemic, our spending is way down, so we could probably afford to make the contributions in the short term, especially at a reduced rate. I feel comfortable with our liquid savings, but there is a big question mark about my employment at the end of June. You know what I would do? I would probably try to beef up the emergency reserve fund for the time being. Even if you're putting a little bit less money in the brokerage account, I would just put that money into the emergency fund, build it up to 1 year, and then go ahead and keep putting money into the Vanguard account. But first, let's get that liquidity up, then keep going. I think that, we'll know more information, but I think you'll be happy to have more liquidity as soon as we can get the telltale signs from your employer about what's going to happen next. So keep that liquidity. Here's Charles, who's 30 years old and single. Again, Mark, single. More news for our dating site. Charles makes 70 grand a year. My employment is stable right now. I've got $40,000 in a 401k, 11,000 in a Roth, 20,000 in stocks and bonds, 20 invested in loans through the lending club, 15,000 in savings. I've been using the lending club account to save for expenses I plan to make within the next 10 years. I'm invested in 60-month term loans weighted toward grade A and B, been averaging 6% in returns so far. I'm unsure how safe or unsafe peer-to-peer lending is right now given the pandemic. Should I withdraw the loan repayments as they come in and add them to my savings account, or keep the money in the lending club account? Okay. I know he says he's got no major expenses. I'm not a huge fan of the peer-to-peer stuff because, look, if things get really ugly in the economy, that could start to look bad. So I would definitely pull the money out of the lending club in terms of the loan repayments. If you want to keep a little bit of money in there, that's fine. I would rather you have a little bit more liquidity and having kind of the boring stuff in there. So I'm assuming that you're maxing out your retirement account and your Roth contributions. But if you're not, what I would also be encouraging you to do is, if you do take money out of that lending club account, to spread it out to make sure that you can beef up your retirement contributions. I think probably a good short-term game plan. All right, I think that's it for this show. Is that right, Mark? Yeah, that's it for a Tuesday. Remember to wash your hands, wear your masks, maintain your physical distancing, and if you're freaking out about your money or have a financial question, don't forget, you can always send us an email. Ask Jill at jillonmoney.com. Maybe you do what someone else did, which is just send someone our email address, and that's your nice thing for the day. Help somebody out. Put your hands on someone's back. Thanks so much for listening. We'll talk to you tomorrow.